Thanks for clicking! All eyes were on Stats Canada this morning as it was set to release Canada's inflation data for the month of June, with many expecting an uptick on hotter than expected economic data that came out last week. We got our answer at 8:30 this morning when inflation did in fact come in as expected at 1.9%, but we did see further accelerations in CPI core, which will no doubt add pressure to the Bank of Canada to keep rates unchanged at the announcement in a few weeks. But it's not just Canada's inflation data that's keeping interest rates elevated. Right now, at least, we're seeing global pressures on Canada's rates, mainly coming from the United States and Japan. So what I want to do today is go over Canada's inflation data for the month of June, take a look at how it's having a marginal impact on our cost of borrowing relative to that of global pressures, and then go over some implications. As we'll see today, we do have a lot of external pressures pushing up interest rates, but we will have an update out on the Bank of Canada's interest rate announcement set for July 30th, as well as the press conference thereafter on this channel. Make sure you click like and subscribe if you want to get those updates, but for now, let's get into this inflation data. Onto the inflation data. As mentioned, Canada's inflation came in as expected at 1.9%. Meanwhile, the real measures, the measure of core inflation which strip out more volatile items like food and gas, showed some upward stickiness, with core median bumping from 3.0 to 3.1 and core trim staying at 3%. Further, if we look at the month-over-month data, we can see some real elevated stickiness over the past few months, which is, in no doubt, what the Bank of Canada did not want to see. Bond yields spiked upwards following the news, as, in conjunction with last week's unemployment data, this all but seals the deal that the Bank of Canada will be holding on interest rates at its next announcement. Ignore. But when we're looking at interest rates, especially fixed mortgage rates, the Bank of Canada is not the place we should be looking. For that, we want to take a look, as always, to global sources, predominantly the United States. First, as we're all well aware, President Trump has been stepping up the rhetoric for Fed Chair Powell to resign from his post as chairman. Most recently, via what many see as a trumped-up charge against the chair for mismanaging renovation costs at the Fed. But given the president's history of consistent attacks against the Fed chair,
we have a moron at the head of the Fed. He's a moron. I tried being nice to the guy. It doesn't help. He's like a knucklehead. No, he's a knucklehead.
Everything is fine.
Given Trump's history, there is a concern that markets could take any ousting of the Federal Reserve chairman badly, selling off treasuries as they did post-Liberation Day, with Deutsche Bank saying that yields, the amount of money that investors charge the United States to lend it money, could surge by 30 to 40 basis points or 0.3 to 0.4% on the ousting of the Fed chair. Let's briefly remember that a bond's price and its yield are inverted. So if investors sold off U.S. debt in response to the Fed chair's removal, that would flood the market with U.S. Treasury bonds decreasing their price and increasing their yield. And the reason, of course, why some investors would sell off their U.S. Treasuries is that were Trump to be successful in ousting Powell, were he able to install some type of loyalist, somehow swing the Fed, we could see looser monetary policy at a time when inflation worries are rampant on concerns of tariff price pass-through. If I'm going to be lending the United States money, or Canada for that matter, and I'm charging 3%, but then the US does something which I know is going to cause inflation to bump up to 4%, I'm going to be losing real purchasing power on my money. And as such, I'm going to demand a higher interest rates when I loan the US money. And as we've seen before, since the yields on US bonds run in near tandem with the yields on Canadian bonds, if that were to happen, if Trump were successful in removing Powell, that would send Canadian bond yields, as well as their mortgage rates, rising.
We should do something!
Second, of course, are the Trump tariffs upon the resumption of the Trump tariff threats last week on the announcement that Canada would be getting slapped with a 35% tariff on all non-USMCA compliant groups. We saw the yield on the 10-year Treasury bump higher, right along with the yield on the 5-year Government of Canada bond, as investors are more and more expecting inflation to rise higher in both countries. And that's been a consistent theme ever since Liberation Day, with investors expecting inflation to bump higher on these tariffs. The yield on the 5-year Government of Canada bond has never once reversed to lower than it was on that day. Further, since Canadian yields move almost in tandem with that of the United States, but we're still a marginal player on the world stage, even if Canada were to get some sort of deal with the Americans, something concrete and sustainable, unless Trump gets a deal with all of the other big players, we are still likely to continue to see elevated US yields, meaning higher mortgage rates for us. Third, of course, is US debt pushing up long-term interest rates, which we've talked about at great length on this channel, so I won't go into it too much here, but suffice to say, with the passage of the Big Beautiful Bill, which included the increase in the US debt limit, this is set to put upward pressure on interest rates, as the US has more and more debt coming to the market. Add to that the $9 trillion in debt that the United States has to refinance, old debt that is rolling over that they now have to refinance at higher rates. The US has an awful lot of debt coming to the market, which, as we mentioned earlier, is going to push up interest rates. And remember, it keeps coming back to this. Prices and yields are inverted. So if we get a greater supply of something, in this case US debt, the price of that debt is going to fall, meaning the yield on those bonds are going to increase. And on that, we can move forward to Japan as it's directly related. The yield on Japan's government bonds has been surging as of late, on Japan's own fiscal worries, with the yields on its 10-year hitting their highest point since 2008. And although Japan is a world away, what happens there has a direct impact on us here in Canada. If Japanese investors can now get a bigger yield on Government of Japan bonds, the highest yield they've been able to get since 2008, they could in fact choose to repatriate their money, move some of their money from US Treasuries back into Japan's government bonds, flooding the market with US Treasuries, lowering their price and increasing US Treasury yields. So, between Trump's unrelenting attacks against the Fed chair, of course the Trump tariffs, the continuing deterioration of the US fiscal position, and rising yields on Japan's government bonds, all of these are putting upward pressure on Canadian interest rates. Now, all of this isn't to say that Trump is going to fire the Fed chair, or that these tariffs are going to stay, that we won't see another taco trade, or that the US won't magically get its structurally deficient fiscal house in order. It won't. Or that Japan won't get its own fiscal house in order. But what this is to say is that there's a lot of global pressures putting upward pressure on interest rates system-wide, not just in the United States, not just in Canada, but globally. Today's inflation data will no doubt add to the pressure on the Bank of Canada to hold interest rates, but again, as we've talked about so many times on this channel, those only affect floating rates, variable rates, lines of credit, etc. Fixed rates, however, are affected by the global bond market, and right now, the global bond market is undergoing some major gyrations. So, Canada's inflation data coming in slightly hotter than expected, relieving some pressure on the Bank of Canada to cut rates. With that said, global bond pressures, events coming out of the United States and Japan, will, at least for now, continue to put upward pressure on Canada's fixed mortgage rates. We will obviously continue to track how this mortgage rate story unfolds on this channel and the global pressures contributing to it. Make sure you click like and subscribe if you want to get those updates, but for now, thanks so much for watching.